Welcome back to Getting Your Shit Together, the podcast where we break down financial strategies to help you maximize your money's potential. I'm Neil, and as always, here with Jerome. Today, we are going to dive into a popular but often misunderstood mortgage strategy. Given that the name of the strategy is under a trademark, and since I have been banned from using its official name, let's call it the equity investment mortgage strategy. I know it's long. Basically, this approach allows homeowners to convert the mortgage on their primary residence, typically their biggest debt, into a potential investment vehicle by leveraging equity to build wealth. We will explore the fundamentals, the benefits, the risk associated with it, and how it might be a game changer for those interested in combining debt management with investment growth. So let's get started and see how the equity investment mortgage strategy could fit into a well-rounded financial plan.
That's a big mouthful to start this one up. Glad to be here, and I'm looking forward to our topics today. And this one in particular, because from what I understand, there's a lot of misinformation out there about it. Not to really double down on terms that are being thrown about so willy-nilly these days. But for starters, let's go through. So what is this strategy and how does it help the average person?
Sure, let's start with that. So basically, the strategy is a Canadian tax strategy, and specific to Canada, that converts non-deductible mortgage debt into tax-deductible investment debt. And so let's start by defining those terms.
Good, I was going to
ask. Just to give some background, in Canada, you cannot deduct the interest you pay on your mortgage when filing your taxes. And this is different from the US system. It works out to be a big disadvantage for Canadian homeowners as long as they're holding that property. And that is why it's called, we call this as the non-deductible mortgage debt. On the flip side, if you borrow money to invest in something with an income generation potential, it could be stocks, bonds, a rental property, or even your business, the interest on such a loan is tax deductible. So, the so-called equity investment mortgage strategy takes advantage of this. The idea is to borrow against your home's equity, invest the funds, and make the interest on that loan tax deductible. Then you use the tax refund or the income generated to pay down your mortgage faster and repeat the process year on year. So that's in a nutshell what the strategy is about.
That's an awfully weird nutshell shape. That's a lot of information, really. And it does sound a bit complex. Well, not a bit complex. It sounds quite complex. So you're borrowing against your home's equity.
Mm-hmm.
Does you have to have a specific type of mortgage in order to be able to do this? Or can you just use like a refinance or?
Yeah, you do need a mortgage, which is specific or a bit different from what you generally get. This kind of mortgage is known as a re-advanceable mortgage. And again, you might not hear the same term, so let me explain the basic construct of that mortgage. So essentially, it is a mortgage tied to a home equity line of credit. And typically, this is registered as a single charge. And essentially, what happens is every month or every week or every bi-weekly basis that you pay your mortgage, which in essentially consists of the principal repayment and the interest, you will see a corresponding increase in the line of credit limit.
Right.
So if you have such a mortgage, which has got a combination of a mortgage and a line of credit, with the line of credit increasing as you pay down the mortgage outstanding, that is typically called as a re-advancing mortgage, and that is what you would need to implement or follow the strategy.
So, in very layman's terms, for every $1,000 I pay, let's just say 750 or 700 of that. Well, no, let's break it down a little bit more borrower positive here. 500 of that $1,000 payment goes to paying down the amount that I borrowed, the principal, and
Yes.
500 goes to the lender for saying, thanks for lending me $1 million,
Mhm.
right? The amount that my mortgage balance decreases is only by the $500.
Yes.
But that $500 now opens up into the line of credit portion, which allows me to borrow back that $500 at a different interest rate, but I'm using it to invest. And
Yes.
that makes that okay.
Yeah. So the
Yeah.
key is the funds are used for an income generating or an investment which has a potential to generate income.
Okay. So I'm borrowing from one side, Peter, and I'm using it to invest over on the other side. Say I'm giving the money to Paul.
Yep.
But the money is still mine, right?
Yes.
And I'm paying interest on one side and earning interest on the other side.
You're earning interest or capital gain or some sort of income on the other
Through
side.
the investment
Yes.
of it.
Yes, through the investment of it. Well,
Okay.
you're also going to pay interest on whatever money you borrow from the line of credit as well. So, of course, your total interest costs are going to go up
Yes.
in the short term, but over the long term, that should typically be coming down. And again, with the tax adjustment that you would get,
Mhm.
effective interest costs should be lower.
Right. Because going back to that comment, the $500 that my line of credit has now increased that I've borrowed against, the
Mhm.
interest that's payable on that now becomes a tax deduction because of this process.
Yes. Now, for let's say the interest that is getting charged on your line of credit
Mhm.
is say 6.95% today. Okay.
Yep.
If you happen to be in a 40% marginal tax bracket, your effective interest rate reduces because of the tax benefit you get. And so
Yep.
the 6.95% could essentially mean it is like 4.17% to you after the benefit of the tax reduction.
Right. And so that will improve the more that I've borrowed for the purpose of investing.
Well, the interest rate itself may not improve,
Yes, that's correct.
but the amount
impact,
of money that you could save on your taxes, yes,
yeah,
that might increase.
the impact, I think, is where I was thinking. So if the difference is if $500 isn't going to make a huge difference on my overall tax bracket if I make $120,000 a year.
Mhm.
But if that line of credit that I'm using, I have utilized $40,000 or $50,000, and the interest that I'm paying on that is now going to help, right? Because the amount is much bigger.
Yes.
The tax break, if you will, has a bigger impact the more that's in there.
Yeah. For example, if you borrowed $50,000,
Mhm.
your interest over that, I'd say 7%, works out to be about 3,500 a year.
Right, right.
Right. So essentially, then that becomes that money is then can be deducted from
Yeah.
your 120,000 of annual taxable income before you have to pay the tax.
Right. So that doesn't sound so bad.
Yeah. Plus the bigger benefit I would say is the 50,000 that you are able to invest
Mhm.
over and above your regular investments or your regular savings.
Yeah.
And that over time can make the bigger difference.
It's like accelerating payments in a way, right? Because under normal circumstances, you would only put let's say 10% of your income.
Mhm.
This allows you to increase that to, say, maybe 11 or 12% in the first year, and then 12 or 13 in the second or third, and so on and so forth. It accelerates. And yeah, that sounds like a really win-win scenario for most people.
Yeah, it's increasingly, I would say, maybe a required strategy for many homeowners. Because let's see, the reality of the situation is many people who are buying a house today
Mhm.
are probably qualifying for the maximum mortgage that they can get,
Today.
right? So you could imagine that at least 30 to 35% of their pre tax income is going towards mortgage.
Yeah.
Even if you assume that 25% is their tax obligation, so 100 minus 25 minus 35, we are down to 60% of your income gone, or your pre-tax income gone, right? So you're left with 40% to manage your life, or your living expenses, save for your future and everything. And that may or may not be sufficient. So the strategy essentially gives you a room to sort of satisfy the needs of future savings,
Yeah.
while you're fulfilling the home ownership desires.
Yeah. And one thing that I think that is important to know is, sorry, I'm just reading from something that I was at yesterday, where they said only 35% of working Canadians age 50 and older could afford to retire. That's a
Yep.
pretty low number. What's an even lower number is that only 27% of Canadians have any kind of a written financial plan. So this really can benefit a lot of people if they're looking at it.
Yes, I would say it is required, or I would say it is a strategy that every homeowner should ideally follow.
Mm-hmm.
The caveat being, I would recommend this strategy only for people who know about investing,
Yeah.
can follow a disciplined approach, and maybe a super conservative strategy around investments,
Yeah.
even while overcoming the hurdle rate of getting a return which is higher than your interest cost.
Yeah. So what would you say to people? So we talked about wanting to have borrowers that have a little bit of experience with investing and so on and so forth. Is there ever a time when it's worth helping teach somebody this process? And how do you go about doing that? Where do we fall with that type of idea? So somebody listening to this today could be like, I don't really have any investments, but I'm intrigued by this idea. What do we
Yeah.
do there?
So if you're not sure about investments, I'm sure there are investment advisors and planners who can help you put together a strategy
Mm-hmm.
that you can use to implement this particular approach that we talked about.
Yeah.
As mortgage brokers, we can obviously help you figure out the best mortgage construct, which
Yes.
can help you implement the strategy. And also, we have access to, or we have a network of financial advisors, investment planners,
Yeah.
who can help you further the strategy. If you're looking at investments like stocks or mutual funds or ETFs.
Yeah.
If your interest is more in the space of real estate, we obviously are connected with realtors who can find suitable investment properties and implement the strategy. Right. So depending on which avenue you want to follow, I'm sure we can connect you with the resources that you would read in order to implement the strategy. Another professional that you would need as part of this process is like a knowledgeable tax account.
Yes. Yes.
Right.
So, okay. So we have this strategy. Us as mortgage brokers are going to be able to help a client with opening up access to available equity that will allow them to implement this type of a strategy. Recommending that they have at least been in communication. Well, I mean, at least have their own experience with investing, or they have access to or reach out to a financial advisor. And I think it's probably equally as important, the tax accountant, so that way they can definitely maximize strategies with the tax planning aspect of things. I don't want to go straight to reducing taxes because that is possible. However, I think the tax planning strategy is probably the most important part. So, I mean, this really does sound like a win-win from a client perspective. Why wouldn't they want to take available equity and make use of it in order to benefit them twice? Once for the investment, right? The future planning. And second is the potential for tax savings today.
Yes.
Anything else that they really need to think about initially if they're somewhat comfortable with investing on their own?
So I kind of highlighted the need for, say, newer homeowners to look at the strategy.
Mm-hmm.
But this is something that can be useful for homeowners who probably have almost paid off their mortgages as well. Because given where home values are today, or property values are today,
Mm-hmm.
they are likely sitting on a couple of $100,000 of equity.
Yeah.
Which, if they have paid off that mortgage, well and good, but that equity is not doing anything much for them today. And so, depending on where they are with their readiness for retirement, it's something that they might want to look at investigating or leveraging if they are short of where they need for a decent retired life.
Yeah. And I can't stress enough, I think, for any individual who owns a house, or even if you don't own a house, part of the reason for our name is to help people understand that nobody is going to do it for you. So you have to take an active role in all aspects of your life, and that retirement planning is probably the primary one that should be taken into consideration a lot sooner than what most people do.
Exactly. I think looking at your retirement and readiness for retirement 10 years or lesser than that or shorter than that it doesn't leave much time.
Yeah. No.
Right?
As I mentioned, go ahead.
Given that the longer the periods that we are living in a post-retired.
Yeah. Says the median age. Can I share some further statistics?
Definitely.
The median age of Canadian retirement says if you're a public sector employee, they tend to retire at around 63 years old. So public sector meaning you work for the government.
If you're a defined pension, a defined benefit pension.
Yeah, you get everything, and we're happy to help you get there. If you're a private sector employee, the average age of retirement is 65.1 years.
Mm-hmm.
If you're self-employed, you want to take a guess on this one, Neil?
70s?
67.8 years.
Okay.
And across all workers, the average is 64.9 years. So, I mean, what that effectively means is people are retiring seemingly sooner than what used to happen. Now, what you just talked about.
And
life expectancy.
Was there a mention about the trend? Are we seeing those ages increase or decrease, or which way is it tending?
No, it wasn't. It was just a statistic, basically like a snapshot, right? Like a static sort of shot as we are today. But the interesting part was what you were alluding to was life expectancy for Canadians. So at the time of birth, and well, I'm just going to kind of go for people, life expectancy for Canadians, it said at age, if from birth for females, it was 83.8 years.
Mhm.
But now, if you're around 65, you can live up to 87.1 years. So you're basically going to be in retirement for like 22 years.
22 years. Yeah.
Right. For males, at birth, it was 79. We were a rowdy crowd. Didn't expect to live long. But now that's actually improved from 79.3 to 84.3 years. So we've gained 5 years by just being calmer and smarter.
So men need to save 4 years lesser than females.
Exactly.
Okay.
But the important part to understand is that you have to budget and plan for your retirement, because I bet you, I don't know what the statistics are, other than what I had mentioned about how many people are actually planning. 27% of Canadians have a written plan, and the rest don't. So that means that, whatever happens, happens, right? There are a lot of spontaneity going on amongst retired people. But wouldn't it be so much nicer to have a bit of a plan?
Absolutely. Again, plans do not go as per the plan, but at least you should have a plan.
That's right. That's right. So so when we look at restructuring somebody's mortgage, in order to make use of this type of a plan, if you will, what are some of those things that people need to think about? Are there some risks involved?
So before we even go there, let me touch upon another aspect, since you talked about structuring or restructuring the mortgage.
Mm-hmm.
So essentially, there are a couple of opportunities where people can look at getting this kind of mortgage. Implement the strategy. One is, if somebody has planned well in advance, they could even be going into this construct of a mortgage right at the time of a purchase.
Yeah.
So if you have 20% down payment, those kind of borrowers are eligible to get that kind of mortgage, like a re-advancing mortgage right at the time of purchase, and start implementing the strategy day one. Otherwise, people who have at least 20% equity in their home can look for an opportunity to refinance and get this mortgage.
Yeah.
Right. So those are the two ways that you can get a re-advanceable mortgage.
So in both cases, you pretty much need to have a minimum amount of equity in the home in order to be able to get this type of a product, basically.
Yeah. Unfortunately, these products are not available when you have an insured mortgage.
Mm-hmm. Mm-hmm. So let's talk about some risks for people in this type of thing, because I think that they know. So what type of risks would the average borrower have when looking at a mortgage like this?
So since we are talking about investments, obviously there is a risk of the investment that you are making, right? So you are borrowing money to invest. And so the success of the strategy depends on how well your investments are doing.
Yeah.
So if they are giving a return lower than the cost of your borrowing, obviously it is not working to your benefit.
Yeah.
If the money is lost because of bad investment decisions, then that is a cause of concern, because the loan obligation still stands.
Yeah.
Right. So those are risks associated with the investment.
So
risk are go ahead.
No, I was just going to say, so choosing good investments for this are very important. But is every investment going to have a great return that's going to be higher than the interest you're paying on the money that you've borrowed?
So that is where the market volatility also comes into play. Depending on the investments, the market values of those investments may go up and down year on year, month on month.
Yeah.
Right. So as long as you have a sound strategy to investment, you have reliable assets that you're investing in. Yeah. The volatility should not really impact you, because you're investing for the long term.
Right.
But if you are more concerned about those investments, yes, it can lead to some degree of heartburn. So you should be able to withstand those circumstances while you ride through those periods.
Yeah, yeah. Right? Those periods are going to be done like this.
Yeah. So if you're somebody who's looking at the value of investments every 5 minutes, yes, it can cause you a lot of anxiety.
Yeah, be the Warren Buffett here, I think is the message, right?
Mhm.
The long term strategy. These aren't, penny stocks where you're going to see them fluctuate
Yeah,
dramatically.
yeah, absolutely.
So,
The,
no, go ahead.
some other risks are, so when you're borrowing from a line of credit, it is a different invest or a loan product than a mortgage.
Yeah.
A line of credit is usually an on-demand loan. So if the bank feels the need, and maybe it is because of situation specific to your case, or maybe it's just the economic environment,
Mhm.
the bank may or may not decide at some point to call the loan back. So that's another risk. It's an on-demand loan, so you run the risk of the bank calling the loan, and obviously you'll have to settle that at that point. So in such a situation, one of the exits, of course, is to sell the investments, pay the taxes, and repay the loan.
Yeah.
Of course, the risk at that point is that if the value of the assets or investments are not at par or higher than the loan that you have to repay, then it could be a undesirable situation.
Yeah. I mean, there is the other option, the not so pleasant option of just simply refinancing, right? Not
Yes.
necessarily with the existing lender that you're with either. It might be, you know, you look at other options available if something
Yeah.
like that were to
I
come up.
just mentioned the worst case scenario, but
Yeah.
again, of course, depending on that specific circumstances, there could be other options as well, or better options as well.
Yeah. Ugh, I mean, we make it all sound so easy, right? But it's not, and there's a lot of things to take into consideration.
Uh-huh.
Um, you've got mortgage financing, you've got HELOC financing, you've got, choosing the right investments and paying attention to what's going on in the market and making sure that your investments are at least coming back at a rate that's hopefully higher than what you're paying in
Mhm.
costs. Um, how do you manage all this stuff? Like, where does that take us?
Yeah. So anybody following the strategy, of course, has to have a disciplined approach.
Yeah.
And since this is a leverage strategy wherein you are claiming tax reduction on interest, it is essential that any investments are used for income generation activities only,
Hmm.
and that you have a proper uh, record keeping that you can sort of stand by if in case there is an audit from CRA or any such activity. So
So
that's
if I,
another risk that I just wanted to highlight as well,
yeah.
that nobody can go cowboy with such investments.
So basically, what you're saying is, I have opened up room on a line of credit that I've now borrowed from for my investments, and I should keep that separate. I can't say to my wife, hey, let's look at our investment statements and go to Outback Steakhouse and have a committee meeting to decide how this is going to work and then use that line of credit to pay for it. That's probably not going to go over well.
No, it may not fly for long.
Right, right. Yeah, CRA for sure. So it's not. This isn't a strategy where you'd pretty much just be like, okay, I'm going to set regular interval payments and set it up and forget it kind of thing. Like it requires, as you mentioned, like discipline and thought, and active participation.
Yeah, and again, it is not too onerous. It is not like you have to spend hours and hours every month to keep up with the strategy. It just requires you to do certain things every month or every quarter, depending on kind of investments you have.
Yeah.
It's all about keeping records and having a proper documentation in place.
Is there are there any groups of people that do this type of stuff and have conversations? Like, could you go to a meetup and maybe discuss different investments with other people in order to try to become more knowledgeable, or would
I
you
have
just?
seen different forums on platforms like Reddit discuss these topics,
Hmm,
but what I've also seen is a lot of misinformation.
hmm,
So, unless you're talking to professionals who know the strategy
yeah,
and can guide you appropriately, you run the risk of not being sure. Again, there are books you can read up and implement the strategy or follow it along.
Yeah.
But key is getting the right advice and instructions that you can follow.
So my neighbor, the mechanic who does this, he's probably not the greatest guy to listen to.
Well, he may know, but the risk is he may also not know everything.
Yeah. So kind of brings things all the way around, from the beginning. We talked a lot about, the process, what this is, how it can help people, how it can benefit you, the need for professionals, unless, there are a lot of people who have been dabbling in the investment market, or maybe more than dabbling in the investment market, and feel very comfortable, logging into a Questrade account or a Scotia iTrade or whatever it is, and making use of that.
Absolutely. There are a lot of DIY individuals out there who do their own investments, do their own taxes.
Yeah.
But they spend a lot of time and energy studying those topics, subjects, knowing what they are doing. And as long as you're one of them, no issues. Go ahead, do that.
Perfect. And also for everybody, like, package your documentation well, so that way it'll help you at tax time.
Absolutely, that is key.
Yeah. Any last thoughts that we want to?
I think we talked the basics of this strategy or approach today in good detail. At some other opportune time, future, we'll probably go through a bit more advanced strategies associated with this approach, which can give added benefit for borrowers, mortgage homeowners who want to follow this strategy and implement it for their benefit.
Yeah,
but I think this is a good place to stop for today.
I do as well. We haven't overstepped any boundaries. We haven't, told people to jump off the cliffs or anything like that. But we've given you a bit of a carrot, let's say, and the idea here is to invite more conversation. Let's talk about your situation and see if it would work, if this type of planning could work for you. I mean, that's the first thing that should happen. From our perspective, it costs you nothing. We don't charge for the time to have these conversations. Now, we're not going to sit online with you and pick stocks, but we'll definitely go through the process and sort of see where you're at. And then maybe even point you in a direction of a professional like a financial planner or a tax person that we can offer as a referral if you need to go there.
Absolutely. And in some circumstances, maybe you already have the mortgage that you need to implement the strategy. Maybe you don't know about it.
Yeah.
So reach out, have a discussion with us. Doesn't take more than 30 minutes to figure things out.
Yeah.
And we can see as to how you could proceed.
Yeah. Maybe you're already on your way to having your shit together. You just don't know it.
Don't know about it.
Yeah, that's right. Okay. Thank you, Neil, and thank you all for listening into this segment of Getting Your Shit Together. And until next time.
Take care.